Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So it's very interesting. We had the IMF come out and basically say that they expect GDP outlook to be better than expected. They see the economy in soft landing. Everything's fine, right? And mostly it's going to come from the US strength and China's fiscal stimulus. Remember, I did a video just not so long back talking about the China's rescue plan, how the stimulus that they're putting out to save their stock market. What we've seen in the past is when they've done some sort of stimulus like that, we have seen that the stock market basically trades sideways and then plunges again afterwards, meaning that there wasn't really much impact from those stimulus that the Chinese have done in the past, right? What makes this time different? And it's very interesting to see the IMF come out and say that, hey, all is rosy. The Chinese stimulus is going to, bring GDP up. Yes, there's risk of inflation and trade and whatnot, which they mentioned, but we're seeing that, we expect that basically soft landing to continue to be the theme, and we see no problems ahead. GDP is going to do well. But then you get another article that comes out and says, this article here, I'll put the link in the description so you could read up on it, comes out from CNBC. It says UPS announces 12,000 job cuts, says package volume slipped last quarter. Interesting. IMF is telling us growth is going to do fine. We're in soft landing. UPS, very big company in the parcel service industry, shipping industry, right? Sending goods around the world. Does that mean less people are buying? Shouldn't that be a sign that demand is slowing down further and further? The fact that also that UPS is cutting and laying off 12,000 jobs. Well, let's dive into it and let's look into it. What happened, right? Well, UPS fell short of Wall Street's revenue estimates Tuesday. They reported earnings, and they reported the drop in the revenue was because of the drop in shipping volume, both internationally and domestically, in its fourth quarter earnings report. The company also announced 12,000 layoffs as part of an effort to align resources in 2024. The workforce reductions will save the company about $1 billion in costs, says the CEO. Shares of the package giant, the stock fell nearly 6% in pre-market trading. And when you look at the earnings, when you dive deep into it, their actually adjusted earnings came at $2.47 versus the $2.46 per share expected. So, the cent higher, so still not so bad. Revenue fell a little bit short, $24.92 billion versus the $25.43 billion expected. So not crazy, ugly earnings report. So then why the 12,000 layoffs, the $1 billion cost saving that you need to do? Is there something that the UPS sees, that the trend quarter over quarter, right, month over month, they're seeing the package delivery business slowing down? Might be something there. For the last 3 quarters of 2023, UPS reported net income of $1.61 billion or $1.87 per share, compared with the $3.45 billion or $3.96 per share a year earlier. Adjusting for one-time items related to pensions and tangible assets, UPS earned $2.47. So yes, we're seeing a decline there versus a year back. Revenue declined 7.8% to $24.9 billion from $27 billion last year. So they were making more revenue before, and we're seeing that revenue decline almost close to 10%. The company reported 7.4% drop in average daily volume domestically and 8.3% 8% decrease internationally. UPS said international decrease was primarily due to softness in Europe. Very interesting, because the IMF was saying that also they expect Europe to do well, the US to do well, China to do well, strength all over. But then the UPS is saying that the softness in Europe is really taking a hit on their revenue. Let's go deeper into this. 2023 was a unique and difficult year, and through it all, we remained focused and on controlling what we could control, stayed on strategy, strengthened our foundation for future growth, says the CEO. Though the earnings report did not directly mention any financial impacts from negotiations with Teamsters in August over labor contracts, CEO cited the negotiations and macroeconomic environment more broadly as contributing to disappointing year. Looking ahead, UPS 2024 outlook expects revenue range from 92 billion to 94.5 billion with adjusted operating margin of 10% to 10.6%. All right, so very important, the shipping company, shipping industry, transportation industry, the trucking industry, the all of these altogether are the life, the heart of the economy. That's how you're going to figure out how demand is truly playing out in an economy. And we've heard this from a lot of shipping companies, right? We heard it from a shipping company, we heard it from transportation companies, trucking industry, jobs being laid off everywhere, right? Because demand is slowing down. There's less need to ship certain items to in domestic countries and also international countries, because everyone's facing the pain with higher inflation and higher rates. So it's very interesting that when you get UPS coming out talking about how they're seeing a decline in their revenue and cutting jobs just like other businesses out there, and then you get the IMF coming out that, hey, soft landing, this is all looking fine. Although the UPS, didn't warn anything, but 12,000 layoffs to save 1 billion in costs, $1 billion in costs, is just the beginning. So, I mean, let's play devil's advocate here too. What if I'm wrong, right? What if the IMF is right? That, okay, this is soft landing, right? Which, again, I always bring back, what's the probabilities of that? When you look in the past, the only time that we saw that soft landing example was in 1995. And when you have all these other variables, like the yield curve, the bond market, the aggressive interest rates, the tightening that has happened, right? We've always seen this play out to some sort of hard landing scenario. And it's going to take time. And you know what's going to get more confusing? Why? Because you're going to see asset prices continue to go up. Things are going to go up. You're going to hear people talk about how much money they made by just not selling, by buying, by sitting on their stocks. People are going to also look at the markets and the equity markets, say, oh, look, I'm missing out. Markets are going higher and higher. This is not financial advice. I'm not a registered financial advisor, so don't take financial advice from me. I'm giving my own 2 cents of how I'm looking at these things and what I'm thinking, that especially when you have the magnificent 7 companies, large tech companies out there pull up the indices, yet many sectors, many indices out there are still not hitting all-time highs the way that the big tech companies are, and pulling the index higher, making it look artificially that the economy is doing fine, makes you really think. I also did a video on this talking about the different indices, going over different also ETFs that haven't hit all-time highs. When you look at, like, for example, the Russell 2000, small cap companies. When you look at, certain industries like the utilities industry, right? The utilities ETF. Yet, the big tech companies, the QQQ, the tech companies, that are also in the S&P 500, those big seven companies like I mentioned, Facebook, or I should say Meta, moving all-time highs, moving higher and higher. Money is flowing into these risky assets at a time where the economy is slowing and teetering here, at a time when you have news like this where there's job layoffs, at a time where inflation is still sticky and the Fed's not done with its job, at a time where there's war, at a time where there's trade tensions, at a time where there's tensions between the two biggest companies like US and China. Makes you think. Of course, you have to start thinking also, how to play out certain strategies, investment strategies. I'm not going to get into it. That's something that you can do with your own your own self or with a registered investment advisor. But it's also sitting on the sidelines for too long may also not be the best strategy. Looking at how you can play in different asset classes to maybe reap some gains while you wait for other opportunities when they present to you and when you feel it's good. That's how you can look at markets rather than just being scared all the time. But it's very good and important to be informed that what is the reality, what's going on, and not to be sucked in by the FOMO. It's very easy to be sucked in by the FOMO. I can tell you it doesn't take much to realize that buying at all-time highs and chasing at all-time highs is probably the worst strategy out there. Seeing and hearing that a stock has moved up higher since ever and has reached its all-time highs, and just because it's done that, and just because you heard someone else made some money on that particular stock, doesn't mean that you need to go and chase. You can always look for other better investments opportunities out there. Don't be sucked in by the FOMO. Same thing. I hear also a lot of realtors out there do the same thing. Oh, there's so many offers on this property. Look, the market's fine. The market's fine. Oh, look, we listed this above the asking price, we sold the house above the asking price, 20% above. We're a genius. We're amazing at what we do. Really? Or did you lower the price so low that obviously you're going to get offers coming in, and obviously they're going to be higher than what the asking price is, and you're going to try to create some sort of bidding war tactic there on a cheaper home, a cheaper price, and then list that as that, look, the economy is fine, right? Look, it's listed above, we sold it above the asking price. Look, we're doing everything right, and the economy's fine. We got hundreds of offers and blah blah blah. Although maybe that may be true for your particular home or for your particular area, but that is not the good way to look at things by just looking at one example of one house. Looking at the big macro things are very important, how all the pieces are being put together. I hear also realtors talk about, once, they got different seasons. Like, once the spring season's here, market's going to pick up, rates are going to be low at that time, and you're going to see real estate shoot up. Well, you didn't see that last year, right? A lot of those seasons where the real estate market was supposed to skyrocket, right? As many of them would say, they didn't happen. Right? So it's just very simple, looking at the big picture, the macro, using a little bit of common sense, and not being too much fear based also is important too. Being balanced, very important. But most important of all is not to be sucked by the FOMO. the fear of missing out. This is what's going to kill you. 100%. The FOMO is going to kill you if you get sucked in by it. And don't. It doesn't matter in anything. Real estate, stocks, crypto, Bitcoin, gold, whatever it is. Don't get sucked into the FOMO. That's the worst thing. No matter what, decision you make, whether it's investing, life, career, etc. Don't follow the FOMO. You often end up getting burnt by doing that. And I've seen countless of examples like this in my whole trading career, over and over and over again, how FOMO has burnt a lot of traders out there. So be careful. So anyways, these are just my 2 cents. Very interesting to see this, UPS announce its layoffs after a slightly below expected earnings report, and very interesting to see IMF talk about the soft landing. And we've got the Federal Reserve this week. It's going to be very interesting to see what they have to say. We've got a lot more US data to track and see what's coming out from that point of view. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.